My name is Martha Whiting, and I'm the Content Marketing Manager here at Wynter. And I'm thrilled to welcome our workshop guest today, Dale Harrison. If you don't already know, Dale is a strategic marketing consultant with a proven track record. He's held multiple C-level roles at mid-sized, high-growth companies, driven success at 4 startups, and has hands-on experience in merger and acquisition transactions. So today, Dale works as a consultant where he guides tech companies around topics of revenue growth, marketing, and marketing effectiveness, which will come in very, very handy today. So we all know that measuring brand marketing is critical, yet often feels very, very intangible. In our recent CFO report we did at Wynter, we found that 56% of CFOs will only invest in brand marketing if it can be tied to ROI directly. So everyone wants to measure it, prove that it works, and link it directly to business outcomes. But how do we do it? And what's the right way to go about it? So whether you're currently measuring brand marketing efforts or you're looking to find a new approach, the good news is that Dale is here today to talk us through his strategy. Now, before I hand over to Dale and we get started with our session, we're going to be having plenty of Q&A time at the end of the session today. So feel free to pop through your questions in the chat box or the Q&A. Please do keep those on SQL and we'll get to those at the end. But enjoy the session and I'll pass over to Dale now.
Thanks. So let me share the presentation. So we're going to talk about ROI and brand measurement. And I want to cover 3 main points. So the first point is marketing ROI. And again, we're talking specifically about marketing ROI. Marketing ROI for brand versus performance. The problems with using ROI to measure brand performance, or to measure brand performance. And then how to actually measure brand marketing outside of ROI. So the first step is to talk about some definitions. And this is something that I think is often missed in marketing. To give you a little bit about my background, I spent time in finance before I ended up falling into marketing. So I've got a formal finance background, and experience in that field. And when marketers talk to business people speak in the language of finance. And finance, one of the things with finance is there are no fuzzy definitions. When you have words have a very specific meaning. And I think most marketers have never been exposed to basic definitions for some of the terms that they're using when they try to talk about performance in the language of finance. So what is ROI? So return on investment. So I think for a lot of people, it's just some vague hand-wavy feel-good term meant to somehow justify that a bunch of spending was worthwhile. The other approach that the business people use is it's a number that's calculated from an exact equation, and that number is calculated in a very precise way. And this is where we have problems with using ROI in marketing just in general, but especially for brand. So to speak specifically about marketing ROI, the marketing ROI is the return on your marketing investment. And I think that's sort of broadly understood. The question is, what do these words mean? What does return mean? What does marketing investment mean? So first of all, it's a return on investments due to marketing activities. But it's just the fraction of sales that was actually influenced by marketing. So there are a lot of other things that are happening that cause sales to occur that have nothing to do with marketing. And so, what the business wants to know is what was the return we got, if you're going to use ROI. What the business would like to know is we spent this money in marketing and what did we get for it? The answer is not 100% of your revenue. The answer is some fraction of revenue because clearly sales is in there. So every single, and if you're in a traditional B2B company with a sales department and a marketing department, every single sale, every closed won deal has significant sales cost. And that's a part of the cost of closing the deal. But presumably that deal was easier to close because marketing did some things. So the question is, what fraction of the final outcome did marketing contribute to? And this is where things start to get difficult. So what marketing ROI is not, it is not your current period revenue divided by your current period marketing cost. This is called a random number and it's complete meaningless nonsense. And the problem is If you show this number to a finance person and you tell them this is how you calculated it, nothing else you say will have any credibility, because the finance people know that this is a nonsense calculation, and that whatever number you're giving them, you may as well have just thrown some dice and written down the numbers, because it's as relevant as what you just did. And so what I want to do is to talk about why that's the case. So continuing on with the definitions. So what is the return part of return on investment? So return is not revenue. And unfortunately, this is how a lot of marketing people calculate marketing ROI, is they just look at revenue. So return is contribution margin. And again, I'm giving you very specific how the business looks at what you're doing definitions. So revenue, contribution margin is the revenue that is remaining after deducting the variable costs associated with producing and selling a product. So we don't take into account the capital investment for the factory, for instance, that made the product, or for the development team that created the product. We're looking at the incremental cost of producing the product plus the incremental costs to get that product sold, to be able to sell one unit of that product to a customer for real dollars. So the question then is, what is return in marketing ROI? So every B2B sale has a significant amount of direct sales cost. So part of that return has to be attributed to those sales costs. So only a portion of each sale is due to marketing activities. And that portion is called incremental revenue. So marketing ROI, the R in ROI has an extremely specific definition. It's contribution margin on incremental revenue due to marketing. And if that's not what you're calculating, you're not calculating ROI. And what we'll see is that this definition really complicates the problem of trying to measure the ROI of brand marketing efforts. So the next half of the equation, return on investment, is what does the word investment mean in marketing ROI? So it's marketing spend that contributed to the sale. But it's marketing spend, but it's whenever that spend occurred. So you could have spent money last week, last month, last year, last quarter, that contributed to the sale. And so this is part of what makes brand measurement via ROI very, very difficult. Because how do you measure brand contribution when a brand campaign that you paid for maybe 18 months ago is what triggered someone who just now is coming in market for the first time in, say, 5 years? They remembered you from that brand campaign that you spent money on 18 months ago, and that's why they reached out and asked to speak to a salesperson. So how are you able to figure out what fraction of your historical spend on brand contributed to that revenue event that occurred today? And this is where it starts to get difficult. So the last thing is I want to throw in, because again, people get very fuzzy with their definitions, and I think it's useful to have common definitions. So definition of brand versus performance marketing. So brand is anything that is primarily designed to implant a durable memory association via your distinctive brand assets into the minds of future buyers not currently in market. Doesn't mean that that brand won't trigger someone who's in market to buy, but again, the idea is its primary purpose is to implant memory associations in the minds of future buyers not currently in market. Performance is designed to elicit an immediate action via call to action in a current end market buyer to advance a purchase process. So if your ad is trying to implant a memory, it's a brand ad. If your ad is primarily designed to elicit a physical action, not necessarily to buy, but simply to, maybe to, look at your, at your product specs, that's one step forward in a purchase process. So you're trying to get them to physically take action to advance a purchase process. And when I talk about brand versus performance marketing, this is the definitions that I'm using. So let's look at ROI for brand versus performance. So ROI works even in finance. ROI is only used for very specific types of investments. And generally, it's investments where the moment in time where you spent the money, say to buy a stock or to buy a bond, and then the moment in time in which you realize the gains from that investment, so the moment that you sell the stock or sell the bond, when those moments are well defined, ROI is the appropriate measurement. The problem with marketing is that we know when the revenue occurred because, again, we can look and see when the closed won deal was done. We should be able to calculate the contribution margin from that closed won deal, and we know the exact point in time, but we do not know the point in time in which the marketing activities influence that sale. And so, and in finance, you have a number of cases where there are similar sorts of investments that you make for which you cannot calculate an ROI. An example is, why are factories inside buildings? Because the building doesn't produce any revenue. It doesn't, it just sits there and eats up costs. You have to keep pouring maintenance costs into it and never puts a dollar in the bank. So what's the ROI of the building? The ROI of the building is the fact that the stuff in the building, the machine tools and the workers are going to be more efficient, more effective, have a higher duty cycle. They're going to be producing product, at a lower cost, faster, and in a higher volume than if you had simply built the factory out in the middle of a field. But there's no way to calculate a precise ROI on a factory building. And in finance, you generally don't. You use other valuation mechanisms to decide whether or not that investment is a good investment. And marketing suffers from very similar issues in terms of just using ROI in general, but specifically with something like brand that tends to be spread out over time. So if we look at performance marketing, typically it's very, very short time to action. So, and typically not more than one sales cycle. So if you're putting out buy now ads, book a demo ad, this is going to impact people that are right now currently in market and, are either already in or just entering a sales cycle. We know from decades of research that these sorts of call to action based performance ads have zero long-term effect on future buyers. Future buyers simply don't even see the ad, and they don't register it, and it doesn't form long-term durable memories. So efficiency of a performance campaign or performance ad can definitely be measured by ROI, but even then rather poorly. The effectiveness can never be measured. And there's an important distinction here between efficiency and effectiveness. Efficiency is a measure of how fast we're burning budget to do an activity. Did we get a lot of activity for a given amount of budget or a little bit of activity? But it doesn't tell us whether the activity was effective. And one of the distinctions here is if you are, if you're the head of marketing for a restaurant, what's the highest ROI campaign you can possibly run? And the answer is that it's to have the hostess hand out 50% off coupons to everyone who walks in the door who already has a reservation. You're going to have essentially zero cost, 100% conversion rate, and thousands of dollars in marketing attributed revenue. But clearly, this is nonsense because you're only handing the 50% off coupons to people who already had a reservation, who are already going to buy anyway. And so that's the difference between efficiency and effectiveness. And this is the challenge with ROI. ROI is an efficiency measure, not an effectiveness measure. But even as an efficiency metric, it can be difficult to calculate in marketing. So by contrast with performance marketing, which tends to work fast and all of its effects are within typically about one sales cycle, brand can work immediately, although it tends to perform much more poorly on active in-market buyers than a good CTA-based performance campaign will. But it will work on buyers immediately. But the important thing about brand is it keeps working for a long time into the future as buyers come in market, because we know from the 95-5 rule that a large fraction of your market is not in market at any given point in time and may not be in market for months or years into the future. And so the point of brand marketing is to implant durable memory traces about the brand in the minds of future buyers, so that next month, next quarter, next year, when they come in market, those memory traces can either be recalled directly or they can be triggered by your performance marketing to then bring them to the brand and have them consider you for the purchase. So, and this is so the fact that brand keeps working over a long period of time as the people, so everyone you showed your brand ad to this month, 95% are not going to be in market, but say 6 months from now, some fraction of those will be in market and some fraction of those will have remembered you and will look you up. But the other thing about brand is it also increases the effectiveness of future performance marketing. So there's a feedback mechanism between your brand marketing and your performance marketing if you do it right. Now, a lot of companies don't do it right. You have to design the creative for both the brand and the performance so that the feedback loop can occur. But if that's done well, there can be a very strong feedback loop where the fact that you did a brand campaign 6 months ago will directly increase the click-through rate, on your performance ads this month. So brand has both a lag effect and a feedback effect. And this is a good example of the lag effect. This is from data. This is from a study from Dream Data, looking at how long before we get the full benefit of a brand campaign that we run this month. And what we see is that we get a lot of the effect relatively quickly, but then there's a long tail where, and the reason for this is that you're exposing people to your brand that are not currently in market, but they will come in market at some unspecified point in the future. And as they come in market, if they still remember you, then that will increase the likelihood that you will go into the consideration set. So prior brand awareness increases the effectiveness of your current period performance marketing. And this feedback problem really complicates calculating an ROI because even the performance marketing is still reliant on expenditures that you made last quarter, 2 quarters ago, 3 quarters ago. And, one of the things I've done personally is I've run, billboard campaigns for highly technical, narrow B2B products, and correlated the time the billboard goes up and comes down with things like the click-through rates on my paid Google ads. And what I'm seeing, what I see is that the moment I put that billboard up, I will get people to start clicking on my ads and start searching, doing organic searches on my brand name. But even months after the billboard goes down, I will still see this effect. I will see this enhanced click-through rate on my paid ads that are slowly declining over time as people forget about, as people sort of lose the brand awareness through forgetting. So this feedback problem is a very real problem, and it complicates being able to calculate ROI for either performance or brand. So this is the core problem with marketing ROI is return on investments. And even if we can figure out what contribution margin for incremental revenue is, the I part of the equation is still a problem. Which investments? So which investments over what time frames? And most of your current period brand investments won't pay off for months or years to come. But even your current period performance investments can take 3 to 6 months to pay if there's a long sales cycle. So if you've got a 90-day sales cycle, all of those leads that your performance marketing generated is not going to produce revenue for another 3 months. And even though, no matter how effective that performance campaign was. So even with performance marketing, you can't simply take your current period revenue divided by your current period marketing cost, because it's a nonsense number. The obvious thing is that for anything other than an instantaneous sales cycle, there's going to be some lag from when you spent that money on performance ads and when that actually generates booked revenue. So you come down to this question of what portion of current period revenue was influenced by current period performance marketing, often very little if you've got a long sales cycle. What portion of prior period brand marketing influenced current period revenue? And then what portion of prior period brand marketing influenced current period performance effectiveness? These are very hard questions to answer, but if you do not have an answer to these, you do not have an ROI number that anybody is going to believe. At least anybody, in a serious position in a business that understands finance will believe. And the deal is, the CFO, even the lower ranking people in finance, they know this stuff. You're not fooling anybody. They're asking themselves this question of how in the world could you come up with these answers? And if you don't, if you're not showing it to them, they're simply not going to believe the number. This is a graph kind of showing you, this is from a model looking at marketing, and especially brand marketing's impact, how it can spread over multiple quarters, so your investment in each individual quarter, much of it will impact, relatively immediately within the sales cycle, the span of the sales cycle. But there's often these very long effects over time. And so how do you take the bits and pieces of all the things you did in the past and apply them to this month's revenue? So overall, ROI is a very poor metric for marketing to be using, and especially poor for trying to measure brand, because you got the incrementality and the lag and feedback effects that just make it a very hard metric to calculate. So there are ways of doing it, but in almost 100% of cases, it requires very sophisticated techniques like marketing mix modeling. And even then, you'll only get these numbers over very long periods of time. You're not going to get this on a month-by-month basis. There are exceptions. So if you're doing completely unbranded direct-to-consumer, so you've got no brand name, you're just running ads for shoes on Facebook, and you're driving them straight to an e-commerce site for an immediate purchase, that's a good way. That's a good context for where ROI can be a very effective measurement. But basically, unless you're like a Temu vendor, this does not apply to you. If you're a serious business in B2B, you do not look like a Temu vendor. And as a result, ROI is not a good calculation to use. So if you want to try to calculate an ROI, a marketing ROI, you're going to have to answer 3 questions. How are you measuring incremental contribution margin due to marketing versus sales? How are you allocating prior period marketing costs to current period sales? And then how are you allocating current period marketing costs to future period sales? If you cannot mathematically answer these 3 questions, you do not have an ROI number, no matter what you're measuring. And again, nobody in finance is fooled. They know these 3 questions. And if you're not giving them good answers for these 3 questions, then they are going to default assume that whatever number you're giving them is garbage, and they're going to ignore it, and they're going to ignore you. So this is the trap I think the marketing has gotten into with trying to use ROI and simply not understanding what's really involved when you do a real ROI calculation and a real financial structure. So you cannot just divide current period marketing costs by current period revenue and get anything other than a meaningless random number. And the only real way around this is to use very sophisticated techniques that can capture these feedback effects and these lag effects and these incrementality effects. But that requires something like, MMM modeling, which is most companies are just not up for. So let's transition into how do we measure brand if we're not going to use ROI? And the answer is it's doable. It's very doable. But you do have to change shift your mindset a bit. So if we start with what does it mean to measure brand marketing? Brand marketing exists to implant durable memory associations in the minds of future buyers. So if the memory association was never implanted, if it was not durable, or if it was implanted in the minds of people who are never going to buy, it is not brand marketing. It is just pissing your money away. So, what we want to do is to try to capture of people that are likely future buyers. What fraction of them have, at any point in time, have we successfully implanted these durable brand memory associations? And again, these memories only have commercial value if they influence future purchase decisions. So we need to basically measure what's locked inside people's brains, which is always a problem. So historically, there are two very broad approaches to brand measurement. We can either ask people to tell us what's inside their brains, or we can observe what those brains do when they decide to buy. And basically, there are no other techniques for doing this, until we can start to do, brain implants and directly take readings out of people's brains. It's either we ask them what they're thinking, or we watch what they do. So, the asking people what they think is the traditional approach that you see in B2C that's been used for over a century now. But it requires some form of market survey work. You have to, a survey is simply asking people what's in their heads, to see changes over time, because this is what we're interested in. As we're pouring resources into brand marketing, what we'd like to see is that more and more future buyers know we exist, so that a higher fraction of potential future buyers will potentially consider us when they come in market. And to see these changes over time, you have to run what's called a longitudinal customer panel, meaning that you've got some population of future buyers that you are tracking over time, quarter by quarter, year by year, and you're continuing to resurvey this group continuously over time. And then you're using that sample to then scale up to the full population of the ICP that you're going after. And again, these are very, very well structured techniques that have been used for, literally generations in B2C. They tend to never be used in B2B. I find very few companies that are doing this in B2B. The second technique is to watch what people do. And again, this is also a traditional technique that goes back a century plus. For CPG brands, things you buy off a shelf at a grocery store, this data is intensively tracked and studied in B2C through typically through retail scan data. So they're looking to see what real buyers are actually pulling off the shelf and scanning and paying with a credit card every single day. With B2B, this is a lot harder because, again, it's hard to get that kind of broad data across your entire market. You may see your sales, but you don't necessarily see what your competitors are doing. But with B2B digital, there are new techniques available. And probably the best of these, which I'm going to talk about, is share of brand aware search. So share of search is basically brand measurement based on behavioral buying signals. It has pros and cons, both of the survey technique and the behavioral buying signal technique. Each have pros and cons, which I'll talk about. But this is actually a fairly effective technique for being able to understand what you're doing with your brand marketing in terms of essentially changing brand awareness in the minds of future buyers. So the first thing is, no one accidentally types your brand name into the Google search bar ever. If they type your brand name in, it means your brand name got inside their brain somehow. And the question is, how did it get there? It did not get there by accident. So it either got there from prior exposure to the product. So maybe they used your product at a prior company, and so they've got some sort of lived experience with the product, and they bring that experience and the memories of those experience to a new company that is now in a buying environment. They could also have been exposed to someone else who had prior awareness of your brand, either through prior brand marketing or through their own lived experience with the product. So we know that a certain amount in B2B, a certain amount of brand choice decisions that are made is certain, essentially the key brands are going to go into the initial consideration set for a purchase. We know that a certain amount of that it comes from the buying committee's prior experience with a product. A certain amount comes from the buying committee asking colleagues, though through word of mouth, but a lot of it is going to come from direct exposure to your prior brand marketing. And to some extent, we don't care if the brand marketing passed through prior lived experience with the product or passed through word of mouth. At the end of the day, all of this is some version of brand and some version of the ability to create brand awareness and brand exposure in the minds of future buyers. So how did they come to search for your brand? So all three derive from some form of prior brand marketing. We can measure this via the level by looking at the level of what's called brand aware search. So search terms that are tied to your brand that they would not have put in accidentally. So did they put in, something to track my sales people with, or did they put in Salesforce? And what you're looking for is searches that show awareness of your specific brand because they're asking for you by name, as opposed to generic searches for, that describe some generic aspect of your product category. And by tracking this over time, we can then see changes in the level of our brand marketing effectiveness. So it's not enough just to take a snapshot in time. You really have to track it over time. So let's quickly go through the pros and cons. Survey versus brand. So surveys have the advantage of sampling across your entire ICP. So you're able to reach both in-market and future buyers. But it suffers from really notorious issues of unreliability of survey data in general. And the famous quote from David Ogilvy: people don't do what they say say what they think, and they don't think what they feel. And so, there are ways to do very, very sophisticated survey design and survey data analysis that allows you to pick out some of these biases. And this has been really perfected by companies like Gartner, who are in the business of doing this kind of research. It's also been perfected by the large B2C brands that heavily rely on this sort of survey data. To be honest, I have never seen a single B2B company in my entire career that knows how to form a survey. Because what you're trying to do is you're trying to ask the same question multiple times in different ways, and then cross-check the self-consistency of those answers to be able to determine whether or not you can believe the answer they're giving you. This goes back to the people don't do what they say don't say what they think, and they don't think what they feel. And by the way, as an aside, this is why self-reported attribution is really a crappy metric. Because self-reported attribution is essentially a single field, unstructured survey question. And it suffers from two problems. One is you're not reaching your entire ICP. You're only reaching those who are in market. So that self-reported attribution only is going to hit the 5% who are in market. You're missing the other 95% that you would normally catch with a good survey design. The other problem is that because it's a free-form single field survey question, you're not able to ask the same question multiple times in different ways to be able to determine the likelihood that this was a true answer. And we also know that there are extremely large biases, structural biases in self-reported attribution. And so all these things together, it's probably worth doing because more information is always better than less, but don't take it seriously and do not use it to measure your brand awareness, because it is not going to tell you. The last problem with self-reported attribution is that you cannot separate out what you did on the performance side versus what you did on the brand side. So it's kind of an amalgam, because at the time you're asking the SRA question, they've been now exposed presumably to both, very recently to performance ads, and then historically to brand ads. And you've got no way of knowing, which of these is really truly where they got the information from, about the existence of your brand. So, so brand aware search, by contrast, has the advantage of relying on behavioral signals, which are very hard to fudge. So asking people what they think is very unreliable because they can tell you anything. But watching what they do tends to be a much truer signal of what's actually inside their heads. But it suffers from the problem of only capturing information from the 5% of buyers who are currently in market. So, and one of the things that results from this is it tends to take a lot longer to see the effects of our brand marketing because we have to wait for enough buyers to come in market to sample them. And one of the other issues that are very closely tied to this is that there's simply a lot of day-to-day noise in the volume of brand aware search data. And typically what you see is about a plus or minus 10% noise level on a weekly basis. So we need enough data over a long enough timeline to be able to, for that trend line to change by effectively more than 10%, to be able for the trend line to change enough to pick it up out of the background noise. And what that generally means is that you're going to need data from about 2 sell cycles. Now, if you're selling butter and you're doing scan data and the average repurchase period for butter is a week, then you need 2 weeks worth of data using retail scan data. But if you're selling a CRM or you're selling, some sort of a cybersecurity package, the repurchase cycle is going to be around 5 years typically for most companies buying a complex multi-tenant piece of SaaS software, which means that only about 5% of your market per quarter is going to come in market, which means you're going to need about 6 months worth of data to begin to see enough change in the trend line in terms of brand aware search, the volume of brand aware search, to be able to pull this up out of the noise. So there are no quick, easy solutions. And there's a similar issue with the survey data. Longitudinal customer panel data is typically something that companies will do either every quarter, every 6 months. But they often need a year or more worth of data, 2 or 3 or 4 data points to be able to see, solidly see changes in up or down in the overall level of brand awareness. So, all of these things make brand measurement not something you're going to be able to do on a day-by-day, quarter-by-quarter, deal-by-deal basis. This is a long-term thing that you're looking at. But it's also something that has, an enormous amount of power in terms of getting you into that day one consideration set for your B2B product. And we know from data, there's now survey data or research data from Gartner, from Forrester, and recent data, some very good data recently from 6 Sense, that says somewhere around 80 to 85% of B2B buyers will have a day one consideration set of typically around 3 brands. They will ultimately consider typically 5 to 7 brands, but their final purchase decision, more than 90% of the time, will be from the day one consideration set, which means that if they do not already know who you are and what you can offer before they ever have a need, then your chance of being selected, of actually being purchased, is extremely low. It's single digit low, versus a brand where those buyers had, prior brand awareness before they had a need. And that cannot be done with performance marketing. That can only be done with brand awareness marketing and building brand awareness in the minds of your future buyers. So ready to answer any questions, but I also invite anybody to reach out to me via email or on LinkedIn. I'm on LinkedIn every single day, so very involved there, and I'm always happy for anyone to reach out, connect. I'll connect with anybody that asks, and I'll answer any questions that anybody wants to send me. So questions.
Okay, perfect. Let's get into it. Thank you ever so much, Del. It was really interesting listening along, taking many notes along the way. We do have a few questions through that came through during the session. Some of them are tracking back to about what ROI means and things like this. So I've got one here from Adita, and she says, do you think that CFOs have this understanding of what is ROI on marketing or brand specifically? So just tracking back to the earlier stuff from the presentation. Yeah.
I have sat in the room and heard the conversations when it was only finance people in the room. Promise you, they understand all these issues. This sort of financial modeling is what they were trained on from an undergraduate. And these are these sort of questions that I'm raising about how did you measure incremental contribution margin. Those things are popping in their head instantaneously, and and the fact is that if you don't have good answers for these, and they're not necessarily going to press you for those answers, if they don't see the answers coming from you, or you say something really stupid like, I calculated it by dividing current period revenue by current period marketing cost, nothing you say from that point forward is going to be believed. So absolutely, these are very, very broadly understood ideas, because again, valuation of investments and financial assets is what finance is all about. And ROI is one of a wide array of potential valuation techniques. And I can tell you, I started in finance doing valuation analysis for M&As. I can promise you, I never did an ROI calculation in that. I had 15 different ways to value assets and to value businesses and to value, what the marketing group was doing, what the sales group was doing. ROI was not in the list, simply because it's a very, very hard number to calculate unless you have a precise moment in time when the investment was made and a precise moment in time when the return was recognized. And that works great if you're buying and selling stocks and bonds, but it does not work so well if either the return is smeared out over long periods of time or the investment is smeared out over long periods of time. And this is where it gets very hard.
Okay, perfect. Thank you, Del. We've got another one here, which is all about different types of techniques. So we've got one person asking about neuro techniques to measure brand marketing. What are your thoughts on this in terms of tracking engagement, attention, and memory through EEG without relying on the bias of self-reporting? Do you have any thoughts on those different techniques as well?
I mean, this is not going to work. Neither will ChatGPT or AI, because how big is your market? Is it 10,000 buyers? Is it 100,000 buyers? Is it 500,000 buyers? Are you going to wire 500,000 people up to an EEG machine? Probably not. And even if you could, there are no known techniques for being able to use brainwaves to tell whether or not you're telling the truth. I mean, this is the whole problem with some of the very sketchy techniques around lie detector machines, which attempt to do something like this. These are very, very hard things to do because we cannot see what's inside people's brains, but that is exactly the thing that we're trying to modify, and therefore the thing that we're trying to elicit. And as a general rule, a really, really well-designed survey can get pretty close to the answer. But the best possible answer is going to be simply watching behavior over time, because behavior tends to not lie. If they actually engage, if they actually make the personal investment of going through a buying process for your brand, that's a high value activity. And again, if what we're trying to do in terms of using brand aware search to measure brand is the fact that we know that they did not accidentally type your name in. They typed your name in because it was already inside their brain, which means that we have absolute positive proof that somehow your brand name got in their brain. And if we can then look at that across enough brains over time, we can then start to get a sense of what fraction of our market is, and again, the brand aware search technique is a lot more involved. I mean, it's a whole course in terms of what you actually do, because you're comparing it against competitors, you're comparing it against total search volume within the space, you're comparing it against non-branded organic search terms. So you're looking for broader patterns to try to understand the answer to the question of everyone that came into market today, what fraction of them know that I exist, and ideally what fraction of them previously know that each one of my competitors exist. And what you'll find often is that there'll be certain brands that have very high volume of brand aware search, which means lots of people know to look for that brand. There'll be other brands with very small amounts. Often these volumes are relatively related to overall share of market, which is also one of the reasons that you want a marketing strategy that's focused on taking market share, because high market share companies have unique advantages that small insurgent brands do not have. And one of these is the fact that the brand name is in the heads of a lot more, higher fraction of potential buyers coming in market.
Okay, perfect. Brilliant. And thinking about tools and practicalities, do you have any tool recommendations at all for measuring brand aware searches?
So I do this, and I've done this for some time. There are new tools coming on the market that help. So, Google Trends has been the old standby. Be honest, it's a pretty crappy tool. A much better tool is something like SEMrush or Ahrefs, except, they're really about engineering paid search campaigns. And so the things that you would really like the tool to do in this regard, they do very poorly. That you can get the data out, but it's often a real struggle to try to extract the data, because they've not done a good job of engineering their product for this purpose. There are new tools like My Telescope is a favorite. It's got issues as well, but it's an increasingly reliable tool. It does not tell you the whole answer. It only gives you a tiny piece. And this is the problem. There's no one magic tool. You're not going to go out and just be able to buy a SaaS and have it magically give you answers. You're going to have to build this up from data out of existing available tools, but the tools are there. So, my 4 kind of standbys is, Google Trends and Google Search Console, along with SEMrush and Ahrefs, and then My Telescope.
Okay, fantastic. Brilliant. Okay, we've got loads more questions coming through into the Q&A as well. I'm not sure if you can see those as well at the same time, Dale. We've got one from Pontus here who says, how do you recommend demonstrating the value of your marketing efforts to a non-marketing audience, for example, the board, if you're a startup without advanced measuring techniques?
I mean, part of the thing is to set the correct expectations with the business, as a marketing person. And, and one of the problems with a startup is, and give you a bit about my background. A lot of my work in B2B has been with VC-backed early stage startups, typically pre-launch. I come in, I help them through product launch and work with them through revenue acceleration, and usually working with them, helping to stand up the initial marketing and sales team. The very first conversation I have with every prospective client that's in that situation is, your number one problem is that no one knows you exist. If you cannot fix that problem, nothing else you do is going to work. And so this is a real problem if you're a startup, is that literally no one knows you exist. No one even knows to look for you or to recognize you if they find you. And, and so one of the recommendations I make in those situations is to start intensive marketing efforts 6 to 12 months before product launch, focused entirely on brand awareness. And then at the moment of product launch, flip to try to leverage that brand awareness you've been building by focusing heavily for the next 6 to 9 months on performance marketing, because in those early stages, you really need to be able to send leads to the sales team. And, and then by 1 year post-launch, then go back to a mixed model where you've got some balance between brand and performance. But, the analogy I give is that if you look at how Hollywood spends marketing dollars, 90% of marketing dollars for a movie is spent before anyone can buy the product, because otherwise every movie would open to empty theaters for the first 3 months, and they don't. And so, it's a very, very good analogy between launching, premiering a movie and launching a product. You start with that no one knows you exist, and if you're not really focused on solving that problem early on, you're going to open to a lot of salespeople with no leads to listen, to follow. And and this is what dooms a lot of early stage companies, is that they may have really good salespeople, they may even have good performance marketing, but if no one knows who you are, you got a very, very poor chance of being put into that initial consideration set, because we know that 90 or 95% of those purchases are done on products that the buyers were already aware of before they came in market. And that's brand awareness.
Okay, brilliant. And so Weston's asking here about if you wanted to build a multi-channel brand building campaign today, what KPIs should be looking for around here that would help in measuring to reconcile the impact in the future? He said here, Google search, volume on brand, direct to site traffic, LLM referral traffic, LinkedIn followers, YouTube followers. Am I on the right track?
I think what you're looking for is, because again, if we step back away from channels and tactics and we think about the purpose of brand marketing is to implant durable memory associations in the minds of future buyers. So anything that gives us some indication that there are future buyers that have, some level of brand awareness inside their brains, that's a positive metric. And so, if they are looking for you by name on LinkedIn, if they're looking, YouTube followers is one example, except the problem is with a lot of these is what fraction of your LinkedIn followers or what fraction of your YouTube followers are actually future buyers, because it's not brand marketing unless you're implanting those memory traces in the minds of future buyers. If you're implanting them in the minds of people who are just never going to buy from you, you're just wasting your money. And so, this is the real challenge, is how do we separate out, not just how many people know us. Again, when BP blew up the Deepwater Horizon in the middle of the Gulf of Mexico, everybody knew the name of BP. A lot of those people were never going to buy from BP. That's not really brand awareness. And so it's not just the fact that there are lots of people who know your name, but are there people who are potential future buyers? And more critically, do they know what you're selling? I'll give you another example. There are things like Chili Piper and Monday.com that have really quite broad brand awareness. But if you look at surveys, a large fraction of people who would recognize that name on a survey, either of those two names, cannot tell you what they sell. So it's not enough that they just know your name. They have to have a durable memory association connecting your brand, your key distinctive branding assets, name, logo, etc., with your product category. If they don't connect you with your product category, it doesn't matter if they know your name. Even if they're a potential buyer within the category, they have to know that what you're selling is in the category. And a lot of this feeds back into how do you design the creative. You have to be able to make, not just remember your name, but remember the association between your name and your product category. And ideally, something that separates you from the other name, those other category associations they've got. So some point of distinction. And a great example of this is what Salesforce did in the first 10 years of their existence. They had, to be honest, a completely crappy product that was barely even capable of being called a CRM. So one of the worst CRMs you ever saw when they launched back in 99. But they had one amazing point of differentiation. They were in the cloud. They were the only CRM in the cloud. But they were an underfunded company going up into an extremely crowded market with a $1 billion competitor in Siebel. That was the 800,000-pound gorilla that had like 80% market share. But what they did was they focused on the fact that they had this one distinctive point of differentiation, which was they were in the cloud, and everyone else, you had to actually rack a server in your server room. And, and so they had the famous no software logo, that said no software and the big circle with a slash through it. And they had Sassy, which was their mascot at the time, which was essentially the no software logo, with a human inside walking around at conferences. And so they leaned in to, these distinctive brand assets that were directly associated with CRM, but also directly highlighted the point of differentiation. It was brilliant brand marketing. It's what built the company that we see today. Because they're hitting all of those points. Remember the company, remember the association to the category, and remember the point of differentiation. And they did all three of these, with just a single image. And this is B2B tech marketing at its finest. And what we see is a $36 billion a year company today as a result of that.
Amazing. No, it's really good to hear the application of those different case studies as well, because it's fascinating to think about how things can change and how it tracks. We've got so many more questions coming through, so I'm going to try and speed through a couple of them here, Dale, because we're almost at time. Juliet's posed a really good question, actually, and I'm interested to see your thoughts on this in terms of limitations. She's asked if there's a risk that customers searching for your brand devalue the share of search measure, and what does that look like?
This is always the problem. Yeah. So for instance, one of the things that happens is, especially with SaaS, especially if you do a poorly thought through product structure, where you want people to come to your homepage to hit the login link versus a separate login.
Mm-hmm.
What people do is they will type your brand. And so one of the things and this is the complexity of actually deploying techniques like this, is that you have to work through this in the back end data. So one of the things you have to do is to be able to tag that traffic that flows through your login link to the product, and be able to back that fraction of brand aware search away. Because a lot of people will just type in your brand name to get to your homepage so they can click the login button. And but this is trackable, and you can back this out. And this is all a part of the techniques associated with tracking brand through various sources of search. Okay, fantastic.
We've got 3 more questions here. So we've got one from Brad. I'm not sure if you can see this. It's one of the slightly longer ones in the Q&A section. Brad asked, what do you consider marketing budget? Is it just working media dollars or non-working? What about salaries of staff and agency fees? Is that part of marketing budget? Also, what do you think of marketing budget and extra share of voice? Spend more to make more?
Yes. So there's a separation here between essentially media budget versus internal expenses.
Yes.
This becomes more of an issue if you're trying to calculate an ROI. But as a general rule, all that money you spent on HubSpot did not make a single person aware of you. Only spending money on media that gets your message in front of people, in front of real life human beings, only that makes them aware of you. And so to a large extent, what you really have to look at is, and again, if you're doing a full financial efficiency analysis, it's a little complicated, because what you want to do is to recognize that your ability to deliver those messages, through those media channels, is the efficiency on that is improved by having marketing automation tools. So you presumably, the more money you spend on HubSpot, the less money you spend on hiring people. That's the theory. Not sure it works in real life, but that's supposed to be the theory. So there are balances there. But at the end of the day, every single dollar you spend on something that does not put a message in front of a set of eyeballs is not building brand. And it's also not building, it's not working on the performance side either. Nope. All that money you spend on buying, on those HubSpot and 6 cent subscriptions for your intent data, none of that caused a person to fill out your demo request form. Only putting a message in front of them asking if they want to fill out a demo request form caused them to. So yeah, so you really have to kind of pull that out. You know, and in terms of ESOV, the idea of excess share of voice, this is an idea, and there's really good data behind it, that if your media budget exceeds, if the fraction of your share of voice exceeds the fraction of your share of market, you will over the long term grow. And so the rough rule of thumb is if your share of voice is 10 percentage points above your share of market, that will translate into between a 1 and 2 percentage point gain per year in market share. Good example of this is exactly how Salesforce grew in the first 12 years, by heavily niching down, basically abandoning 90% of the CRM market, heavily niching down, putting all of their limited financial resources in a very, very tight niche around basically SMBs who had understaffed, under-resourced IT departments. And therefore they can make the pitch that you don't need to wait for IT to rack a server to install your CRM system. Just give us your credit card and it'll magically show up in your browser. That was a great pitch in 2004. And yeah, but what that allowed them to do was, within that market, they had a much bigger voice than their share of market would tend to, they would have had, based purely on their share of market. And part of the idea here is that all companies within a category will tend to spend roughly a similar share of available cash on marketing. And so if you're Salesforce at $36 billion a year, you've got, if you're spending, 13% of your revenue on marketing, that's a lot more dollars than if you're some, Billy Bob super AI CRM, with 20 million in sales. Your 13% is not a lot. And so, what happens is that the bigger the market share of the company is, the bigger their megaphone is, simply because everyone is spending roughly an equal share of available cash, whether that cash comes from revenue or that cash comes from VCs. That you basically cannot spend more money than what's in the bank. And, and you have other expenses. So you have a cap on the percentage of revenue of available cash you can spend on marketing. And that leads to a hierarchy in the volume of voices. And the trick is to narrow your target market to a subset of the ICP so that you can have a louder voice within that subset, than you would have had compared to your competitors, had you attempted to go after the entire market. And again, this is where I see a lot of especially SaaS startups fail, is that, they have these insanely wrong notions that they're going to be able to get, giant Fortune 500 companies to buy their product. They're not. That they're going to be able to somehow compete against everyone else by being creative and have lots of influencers. You're not. The problem is that it costs a certain amount of money to put your stuff in front of a certain number of eyeballs. And if you have less dollars, that means less eyeballs. And, and if you can niche down, then you can potentially make those eyeballs count a lot more, especially if you're like Salesforce and you're able to niche to a small niche that really, really cared about the fact that they were in the cloud. Then every one of those eyeballs is a lot more likely to buy and worth a lot more. And so your dollars go a lot further. And that's the whole concept of excess share of voice.
Okay, perfect. Brilliant. We've got one final question here from Pontus. Maybe he says, I've missed part of the webinar, so forgive me if this has been covered, but how do we pick the competitors to feature in our share of search metric? How would you recommend going about that, Wynter?
That's a good question, because the problem that I've seen is typically that people underchoose rather than overchoose.
Okay.
That they have an overly narrow definition of what a competitor is. And the answer is, a competitor is not who you think a competitor is. A competitor is who a future buyer is willing to consider to solve their problem. And so, for instance, and I'll give you a very specific example with a company I'm working with right now. They sell inventory management software to e-commerce merchants. So there's a series of major competitors. Sin7 is a big one. There's a number of these companies. Even QuickBooks inventory is often used. There are a number of companies that are explicitly selling inventory management to e-commerce merchants. The vast majority of all e-commerce merchants, they use Excel. So Excel is your biggest, toughest competitor. And and so looking for things like how to use Excel to do inventory management as a search term, is part of what has to kind of go into the mix, because Excel is your single biggest competitor, not any of your branded named competitors. And a lot of times, especially in technology areas, there are things that you don't necessarily think of as a competitor that represents a viable buying option for a future potential purchaser of your product to consider to solve their problem. Because again, your future buyers are not buying products, they're buying solutions to problems. And so you have to broaden your definition of competitor to include available solutions to the category of problem you address.
Okay, perfect. Brilliant. So I think that brings us to time here, everyone. If you have any further questions at all, feel free to reach out to me or Dale via LinkedIn, and hopefully we'll be able to see you next week as well. But thank you ever so much, Dale, for joining. It's been a fantastic session. I've thoroughly enjoyed it. And thank you, everyone, so much for all your questions as well.